As we all switch gears and think about the year ahead, we thought we'd do the same and look at some of the things that are likely to impact equity markets in 2024. As a long-term, valuation-oriented investor who likes to think in 5 or 7-year increments, I admittedly squirm in my chair a bit when I get the question, so what's the market going to do this year, Brett? Having been at this for more than 25 years, I know that valuations may be a great indicator in the long term. But in the short term, other factors weigh just as heavily. And since our CFO report focuses on valuations in the longer time frame, we thought in this video we'd look at some of those shorter term factors and also whether, in our view, they are currently pointing in a more bearish or bullish direction. It's always my preference to finish on a more positive or bullish note. So let's start with some of the things on the bearish side where that might be headwinds for stocks. The first one is economic momentum. This one might be a bit of a surprise, and some folks might even disagree with it, given the eye-opening 5.2% growth we just saw during the third quarter. That figure is backward-looking though, and some of the forward-looking indicators aren't quite as positive. Consumer spending has kept the economy strong this year, but there are some cracks starting to show in that story, as auto and credit delinquencies are on the rise. And as this heat map on the Purchasing Managers Index shows, we've seen a deceleration in manufacturing and services activity across the globe. Scores above 50 indicate growth, whereas scores below 50 indicate the opposite. Most regions and countries are now hovering just around that 50 mark, or are already below. Our second note relates to next fall's elections here in the US. As much as we try to tell investors to not get caught up or frozen due to the elections, we know we're probably fighting a losing battle. The fact that this cycle seems destined to be even more contentious than usual certainly won't help. No list is ever exhaustive, but the other big item worth noting is around commercial and office real estate. That market continues to feel the impact of higher interest rates and softer demand. And as one of our asset manager partners expressed recently, they think we're still in the first couple of innings of the fallout from that. Okay, enough doom and gloom. Let's switch over to some of the things that appear more bullish or that may prove to be a tailwind for stocks. The first thing that comes to mind is inflation. While still a little above the Fed's target rate, it has come down a lot and happened faster than many expected. It also appears set to fall further, which leads us into our next possible tailwind, the Fed and monetary policy. With inflation pressures easing, it appears that the Fed is likely done hiking rates, and historically, that has been a very positive thing for stocks. After their last meeting, the Fed even gave the market hope that they could cut rates in 2024. I suspect they'll walk that part back a bit over the next few months, but it certainly gave a positive jolt to markets in December. Were rate cuts to happen, it could trigger more demand for stocks due to the large cash balances many investors have today. With money market yields hovering around 5%, investors have been quite happy to stockpile cash. Should that yield come down, those funds would likely find a new home, with some inevitably ending up in stocks. As is always the case, both the bears and the bulls have plenty of things they can point to in order to support their view. The reality is, nobody knows for sure. And what ultimately swings things in one direction or the other may be something completely out of the blue. As our investors know, that's why we keep our focus on the long term and on the things we can calculate or quantify, and let valuations drive our decisions. I hope you'll stay with me as I pivot in the next video to talk about one of the hotter topics in investing over the last year, artificial intelligence.